Brilliant. Good afternoon, everyone. Hope you can all hear me and see me clearly. I think we'll get started straight away. So thank you, everyone, for joining us. Happy New Year to all of you who have joined as well. It's no doubt the last quarter, and especially the start of this year, has been somewhat volatile start for financial markets. So we're going to start today by recapping what's happened this quarter and also 2021 as a whole, and hopefully explain to you some of the things we saw. Most notably, I think the topic that's come up quite a lot is inflation and what central banks are going to do. So we're going to be giving you our thoughts on what their activity is likely going to be moving forward, but also how this will impact our portfolios and your investments. As always, at the end of the webinar, we'll be giving a Q&A. So please feel free to ask any questions you may have. There is a function at the bottom or the top of the screen which should be able to help you do that. And yeah, so with that, I'll pass on to Mo, who's going to start by recapping 2021.
Good afternoon, everyone. Thank you very much for taking the time to join us today, and Happy New Year. So if we go straight into a recap of last year, the key theme was inflation. We had been speaking about this a year ago in our webinar at the start of 2021 as a potential issue for markets, and ultimately it did dominate what happened in the markets across different geographies and different sectors. As I'm sure many of you are aware, there was a large increase in the cost of both goods and services, and specifically within commodity prices, there was a very significant increase amongst a range of commodities, most notably European natural gas, which increased by 350% over the year. Of course, we had a couple of new COVID strains, which dominated things on the health front. So Delta was the key one through the sort of early to middle part of the year and into the latter stage of the year. And then more recently, the Omicron strain. So they in turn had different impacts on the markets. I would say the Omicrons had more of an impact from an economic perspective. And that has led to, in combination with inflation, a great deal of volatility at the sector level. So if we think about the FTSE 100 or the S&P 500 in America, at this sort of index level, you haven't seen that much volatility in those particular indices. But when you look under the bonnet at the underlying companies and particular sectors that they occupy, you've had quite a different experience depending on which sector you are sitting in. The central banks have been quite sanguine about the backdrop up until sort of fourth quarter of last year. So they were in the camp that they felt inflation was going to pass, and they didn't really need to react, but that hasn't quite materialized. And so what we saw in the fourth quarter was a very different tone emerging from the central banks, particularly the US Federal Reserve and the Bank of England. And we will expand on this a bit later on when we cover this in more detail. As far as sort of performance goes, across the portfolios, obviously we run a number of strategies. Returns was between mid to high single digits, and in some cases double digit by the end of last year. So if we move on to sort of hot topics, if you like, at the moment, inflation and central banks. So many of you may be monitoring inflation data, and we've seen that on a year-on-year basis, inflation as measured by CPI, the Consumer Price Index, has risen quite materially. So in America, we had a print of 7% last week. And today we're expecting an announcement on the UK CPI, which is expected to be 5.3% on a year-on-year basis, which will be the highest level in 30 years. If we just sort of dissect that a little bit and look at what has been driving the inflation higher, we've sort of coined these as sort of cyclical inflation and non-cyclical. So cyclical is an example is sort of energy prices. So, you know, as demand increases, the price or value of it goes up, and then as demand falls, they go down. So there's a sort of a cyclical nature to energy prices, for example. Non-cyclical will be something like wage inflation. So once wage inflation starts to come through, it's deemed to be much stickier, and it doesn't really go away anytime soon. So you've had a pickup on both sides of this of the fence, if you like, on both the cyclical and non-cyclical inflation, leading to much higher levels of year-on-year inflation data. What's basically happened in the markets is that you've had a couple of things. Firstly, bond yields, so government bond yields, and I know we have touched on this in the past, generally went upwards over the course of the year. There was lots of ebbing and flowing, but generally speaking, went up in an upward direction, and that had an impact clearly on the bond markets, which we have not been particular fans of all year. And you may recall in my January update last year that we were quite aggressively reducing our bond exposure in favor of hedge funds because we were concerned about the backdrop then. And the inflation data and this sort of cyclical, non-cyclical mixed with COVID has led to these gyrations between different sectors. So the growth sectors, typically populated by technology, had periods when they were going up, and then there were others when they came under a lot of pressure. And on the other side, we had these more economically sensitive sectors, such as banks, performing at different stages. So you had, particularly in the first quarter of last year, you had a big sort of move between them. And then from sort of the second and third quarters, it shifted back to growth. And then the end of the year, there was another sort of gyration between those sectors. So under the bonnet, there was quite a great deal of volatility depending on which sector you're looking at. The central banks, as I mentioned earlier, have moved away from their language, the sort of sanguine language, which they are commonly referring to as transitory, because they believe that going back to the sort of cyclical, non-cyclical inflation, they felt that the cyclical element was going to ease back as demand fell. But that actually turned out to be incorrect, and that cyclical elements haven't really eased back at all. And as we've seen more recently, energy prices have gone up quite dramatically. That, coupled with ongoing wage inflation, has caused them to have quite a material shift in their stance, and very quickly. And they are now talking about, looking at the US Federal Reserve, for example, talking about tapering their QE program. So when the pandemic emerged, they threw a huge amount of money. We're talking trillions of dollars at the economy to try and help the economy get through the effects of the pandemic. And now what they're doing is they are tapering the growth in that stimulus. And they have indicated that they would like to end that process sooner rather than later. So we're probably looking at March by the time the growth of the stimulus starts to flatline. They have also indicated the potential for interest rates to rise, and we may be looking at as early as March, possibly May, for the first interest rate rises to come through in the States. Of course, in the Bank of England have already raised interest rates, and it's very likely, given the inflationary backdrop, that they will follow suit with the US Federal Reserve and raise interest rates as well. So as far as actions go, I think we've been dealing with this for about a year now, where we've been targeting specific areas of the portfolios. As I mentioned, we reduced our bond exposure. In the sort of back end of the summer, we increased our exposure to the economically sensitive sectors in expectation of a further move towards them in the sort of Q3, Q4 period. And I will touch on actions sort of moving forwards as well, but the sort of general gist is that will continue to occur through the portfolios over the next sort of weeks and months. So if you just think about moving forwards and our thoughts, last year dominated by the inflation story, and I think whilst that obviously is still very important, it's probably going to become more important at what the central banks are now doing and how they're reacting to inflation not tailing away as they expected. There is the potential, and they have hinted at this, that we may see something called quantitative tightening, which is basically when I talked about the stimulus that they've injected in the economy, and at the moment they are slowing the growth of that, and at some point that will flatline, so we know growth in stimulus. They are now potentially suggesting that they may start to withdraw some of that stimulus. And obviously if that's the case, if that's true, what we in that environment expect is higher levels of market volatility. The markets generally like stimulus and don't particularly like it when the stimulus is taken away. Based on that, we expect the gyrations between the growth and the more economically sensitive sectors to continue. and so for us, what we're going to be doing here is we've already actually made some adjustments on the first day back of the new year, in that we reduced some of our exposure that is sitting within the sort of higher growth parts of the market, because they have come under pressure. They came under pressure in the last sort of 4 or 5 weeks of last year. The weakness has continued, and so we felt that, look, it's quite important that we lighten up on some of that exposure there. And so we did reduce already some exposure. We are very likely to continue reducing our exposure to those particular areas. And the areas that we've focused on are funds or ETFs that are not necessarily getting caught up in these gyrations between growth and value. An example is the Guinness Global Equity Income Fund that we've owned for many years in our income models. And the nature of that fund and the way they invest money has helped them to navigate and sort of almost sail through these volatile periods that we've seen between different sectors. Given that we expect this to continue in the new year and volatility to increase, we have actually allocated more to that fund in some of our portfolios. And we have also brought in another income strategy in the UK to try and mitigate some of these risks. Yeah, and then probably this other, I've already just talked about the sort of defensive equity thing, but the other part is, it's the hedge funds versus bond argument, which we were quite aggressive on a year ago. At the moment, the environment still looks very difficult for the bond markets, especially if you've got more hawkish central banks. And so at the moment, we are going to stick with our hedge funds versus bonds. And if there's at any point we see that the central banks are starting to change their stance, then we will reconsider and potentially add back to bonds. But at the moment, we're going to keep it the way it is. And as I just mentioned, we are looking at equity funds that are more defensive in nature and don't necessarily get caught up in the gyrations between growth and value. So just to summarize, markets are very likely to be driven by central banks, at least in the next quarter, if not longer. They, of course, will be monitoring inflation very closely, and that will probably determine their course of action. At the moment, inflation data is very elevated, and so they are very likely to continue down the path that they've set out over the last sort of month or two. And as I mentioned, markets are therefore likely to be more volatile, at least for the next quarter. So as mentioned, we'll be looking at trying to reposition slightly. Well, we already have, and we'll be continuing to reposition into slightly more defensive assets to better navigate the current environment. Okay, that brings me on to the question and answer session. So if you have any questions, Tommy here will read them out for me, and I will try my best to answer them.
Brilliant, yeah. Thank you for that, Mo. That was really comprehensive. You've got a couple of questions. So First of all, just more generally speaking, does this sort of higher inflationary environment sort of benefit certain geographies and certain sort of indices? So, for example, I'm thinking about perhaps the UK and the FTSE 100, which typically is more value oriented. Do you think that sort of do you think that would do better in this type of environment compared to, say, a tech-heavy Nasdaq, for example?
Yeah, absolutely. Different indices are made up by different companies, and it's publicized and documented that the FTSE 100 has a very heavy bias towards more economically sensitive sectors such as banks and energy companies. So in this environment where you are, and right now, as of today and this year, we have seen some of those sectors do quite well. And therefore the FTSE 100 has actually got off to quite a good start this year. Conversely, the Nasdaq, which is very heavy in the sort of technology sector, has come under pressure this year so far, and therefore I guess the short answer is yes, it's certainly going to impact particular indices and geographies.
Brilliant, cool. Okay. Another question has come in. Where do you see the US 10-year Treasury yield by the end of year? Closer to 4% or closer to 0.5%?
I certainly do not see it going to 4%. We are at a 2-year high at the moment, at about I think it's just dipped below, actually. It's now about 1.7%. In the short term, the likelihood is that it's going to continue going up, because at the moment, the US Federal Reserve are becoming increasingly hawkish, and are pricing or talking about bringing in more interest rates in the shorter term. So the markets are having to take that into account and reprice, if you like. So at the moment, we're seeing bond yields go upwards. And always to remember that the markets are discounting the future. So they will be pricing in what they expect to happen now. And so with bond yields going up quite quickly and materially in the short term, the markets are expecting US Federal Reserve to react more aggressively. So, the question is, how much more aggressive can they become? Of course, they can become more aggressive, but I think the likelihood is that it won't be significantly more, because if that happened, that's likely to lead to problems in the stock markets. So I think the yield may end up being somewhere around this level, and in the first quarter, it may go up to 2%. And post that, I actually think that yields might end up falling again, actually, from the second quarter onwards.
Mm-hmm. An environment with falling yields, would that benefit sort of tech stocks, those sort of longer duration, higher growth stocks?
Yeah, so higher bond yields basically means good for economically sensitive sectors, not so good for growth sectors, such as technology, and vice versa.
Mm-hmm. And slightly moving away from traditional markets, but we've seen crypto markets take quite a big hit recently. Is that something that can be associated with this sort of environment as well?
Yeah, I think clearly it's quite a difficult market to understand in terms of the dynamics that move it. But I think the simplest way to look at it is in terms of investor sentiment. So at the moment, investor sentiment is weakening because of the action of central banks at the moment. And with the central banks becoming more hawkish, you're seeing sentiment across a number of areas weaken, particularly the more speculative parts of the market. So I think, given that crypto, Bitcoin, etc., has come under a lot of pressure, as some of that speculative money has been coming out of that market.
Sure. Okay. Another question is sort of centered around sort of looking at equities with a more quality focus. Do you think you will be looking into funds that invest in those sorts of companies, given our slightly kind of more defensive stance into the year?
Yeah, and by defensive, I think you sort of naturally gravitate towards quality. So taking the Guinness Club Equity Fund I just mentioned, they have a very strong focus on quality in the companies they buy, and quite often what you find is that quality does tend to do quite well in these particular environments, coupled with specific sectors that also tend to be quite defensive. So, but yeah, quality I think is going to be quite important, and especially given the inflationary backdrop, companies that have pricing power are going to be very important. So they naturally are, the higher quality businesses, so that they can pass on the increase in costs that everybody's experiencing at the moment.
Yeah, and it might be helpful actually. Could you quickly sort of, when you talk about quality, high quality companies, what makes a company high quality?
Well, there are obviously several interpretations of what quality means to different people, but in a nutshell, it's the revenue that they can generate year on year, the consistency of that revenue over time, if they're paying dividends, the reliability of them paying that dividend, and whether they can keep growing the dividend, etc. So there are several metrics that you can look at, but those that tend to be relatively stable in terms on the earnings front and on the dividend front tend to fall into sort of the quality category.
Sure. Okay. Another question. So looking back on 21, could you sort of briefly speak about what worked well for us and also what didn't work so well?
Yeah. It depends obviously which portfolio you're in, but trying to speak sort of broadly, the switch from bonds to hedge funds was a good move for us. It worked well, particularly in the first quarter of last year. There wasn't a huge amount of difference later on through the course of the year, but that first quarter was very important. So that worked relatively well. Our exposure to UK equities was very good. Coming into last year, we actually doubled our exposure to the small and micro cap parts of the markets. They went on to become something, I think they were some of our best performing holdings in the active models, with the Liontrust UK Microcap Fund, I think, delivering 35% in the end. So that was also quite good for us. Some of the underlying funds relative to their respective markets performed quite well. I think in terms of things that didn't work so well, gold didn't have a great year last year, both on the physical gold front and the companies obviously that mine gold. They generally detracted.
And is that surprising given the environment we're currently in?
Well, this is a big debate at the moment. Not here, but I mean just generally across financial institutions as to what has happened with gold, because traditionally gold, has for millennia been an inflation hedge, or at least been viewed as that. So, given the environment that we've had in the last year, gold should have performed spectacularly well, and actually it didn't do anything at all. In fact, it was slightly, I think it ended the year down about 5%. So there's a lot of head scratching going as to what exactly has happened with gold. Many institutions have come out saying that they continue to be positive on gold, and they expect gold to be higher by the end of this year. But clearly it's been quite disappointing so far.
Okay. Another question actually. Is it likely that digital currencies will play a part in your tactical and strategic allocations to cash?
Digital currencies?
Yeah.
Not for the time being, no. I think I've said this in the past, that I do think digital currencies are the future. However, it probably depends on what digital currency we're talking about. And if we're talking about cryptocurrencies, the FCA have taken quite a dim view towards that particular asset class, and won't allow us to invest in them for any of our clients. So from that perspective, No. Maybe, I don't know, 5-10 years time, perhaps that may be something on the table, but certainly not now.
Yeah, brilliant. Okay, well, we don't have any more questions for now, but if anyone has any more, please send them in. But if not, if you want to get in touch with us after this webinar, you're more than welcome to email us, any of us at the team directly, and we'll be sure to answer those questions for you. But I can't see any more coming in, so I think with that we'll end the webinar and the Q&A. So
Brilliant.
thank you everyone for joining us. It's great to see so many of you, and hopefully we'll speak to somebody very soon.
Thank you very much, everyone. Take care.